right now, in the paper world, when it comes to the spot market, right, which is just a paper market, they can create as much gold and silver that do not nor ever will exist.
Exactly.
But there is a completely different thing that's happening in the physical only world, which is like this,
Real
and
metal.
even, you know, in the silver, right?
Right.
So we have the spot markets in gold anyway, making a triple top, meaning that it goes up to this resistance level, hits it, and then backs off, goes up again, hits it, backs off, goes up again, hits it, and backs off. So there's a triple top that's happening technically, but if you look on the graphs that are physical only, what you see is a breakout. So in other words, those are going up to more recent highs, whereas the spot market is bumping its head, and the premium on silver, I just pulled this yesterday. I think the spot on the 16th was, what was that, 2263 is where it closed, something like that. And the mint has 2023 silver American Eagle for, what was that, $76?
Yeah.
Or something like that. That should show you that, and the fact that at SLV, so that the silver ETF, they changed their prospectus a couple of years ago because they couldn't pull enough silver from the markets to create the baskets. So, I mean,
okay.
You know, what does that tell you about the physical markets? Those are two different markets. One is about trading and also perception management, because a rising gold price is an indication of a failing currency. So that's why you had that triple top. It keeps trying to break out, but it keeps getting suppressed for that reason. And so when you're looking at, well, what are they trying to do? They want you in the system so that you are 100% dependent upon them. And once they institute those CBDCs using blockchain technology and smart contracts, then that means that they can dictate everything to you. What you can buy, where you can buy it, how much of it you can buy. If you're buying too much, they can cut you off. I mean, then you have to do what they want you to do, or you've got problems. So just like we saw in March with the regional banks going out, SVB, et cetera, the reason why they did that was exactly this reason. Interest rates had changed since once they bought those bonds, and the market value of those bonds are substantially lower. Right? And so you saw banks go out, and that issue has not been solved yet, because we've got every bank and most corporations, almost every corporation, also sitting on a ton of losses that if they just say, well, we're holding them to market or until they mature, then they stay at that market, but that's not the truth. So when you're talking about misdirection, I mean, are you hearing too much about this anymore? And what nobody knows is what is going to be that one little piece that pushes it to past the point of any level of return.
Yeah,
because
that domino.
Exactly. Because the real problem is we are at the end of the currency's life cycle. There is admittedly no purchasing power left.
Right.
And
it's getting worse.
Exactly. That's what that inflation shows you.
Yes.
And right. And so if you have no purchasing power left, and then the key tool, or even let's say tools that the central banks have to manage that, one are interest rates, right? And we already see, you know, what's happening in the interest rate arena and the havoc that that's caused, especially in the treasury market.
Yes.
But the other is that confidence piece. And
which is the biggest one.
It is. This is a Ponzi scheme. You got to have that confidence, and you got to have new money. Those are the two things that you need in any Ponzi scheme. Is you need that confidence and you need new money. And they're having problem in both areas. I mean, significant problems. Things used to be a lot more local, meaning that if I had a problem with something, I would go to the decision maker and I would say, here's my problem. And then that decision maker would want to solve my problem because they'd want to keep me as a customer, whether it's a government or it's a mom and pop shop, what have you. But over the years and the growth of all of this technology has created a distance, right? So now if you have a problem with something, are you going to get to a decision maker?
No, it's very difficult.
To a gatekeeper.
Yep.
So when you're talking about blockchain technology, smart contracts that lay on top of things, autonomous driving cars, distance between policy, this is what the central banks say, we want distance between their policy and how it's introduced to the public. That all goes back to what they want, which is a full surveillance economy. And the tech companies have that data. The banks have the personal relationships. It's sticky. You don't change banks very often. It's nudging you in the direction that they want you to go in, which frankly is to keep all of your wealth inside of the system because, hey, when a market crashes, who are you going to complain to, right? If that's where you're holding your wealth, that's really why I like physical, tangible assets at this 100%. Point in the trend cycle. You know, at this point in the trend cycle.
Definitely. That's wealth protection right there. That's how you protect your hard-earned money.
One of the things I find really interesting is that they are not talking about the SOFR LIBOR shift, interest rate benchmark shift, which is the biggest experiment that has ever been attempted, ever. The LIBOR stands for London Interbank Offer Rate, which is the rates that banks would pay each other overnight. And it is just a stated rate. They created it in the 1980s, and it's embedded in every single contract on the planet, okay? In 2000, but what I mean by a stated rate, you would just have a handful of banks that would get together and say, gee, if I were gonna loan you money overnight, this is what I would charge you. And if I were gonna borrow money overnight, this is how much I'd be willing to pay you. But shockingly, in 2008, the traders were manipulating that rate for their benefit, away from the clients, but for their benefits. And the fact of that scandal got leaked. And since it got leaked, then the global central banks needed to create a new benchmark and take all of these trillions and quadrillions of dollars worth of contracts and shift them from the London interbank offer rate to, in the US, it's called the SOFR,